Well, good day, everybody. At least in the Midwest, we have unseasonably warm weather, so that's a very welcome thing as we quickly approach Thanksgiving. But welcome back to another edition of Check the Map. We're in the second half of November, and I'm Tyler Bannister, joined by Nick Wages and Kirsten Crum of SRG Financial Advisors. Government shutdown is over. All right, I think we talked about that for at least the last two editions of Check the Map. We got to that new record point. It's over now, but there's a lot to talk about as far as inflation adjustments for different limits, contribution limits, tax rates, et cetera, healthcare for next year. Also, want to talk about just kind of the lay of the land for household personal finances across the U.S. right now. So, coming out of the government shutdown was definitely tough for a lot of households,
Higher
but
than it was
there's
had
there's also a lot of happening going into the rest of this year, early next year. Now, what the market's done since our last check the map, it's actually been less than 2 weeks at this point since our last check the map edition, but there has been some market movement. You have U.S. aggregate bonds actually pulling back about 0.14% in the last week and a half or so. We've got the S&P 500 down about a 0.5%. Tech has really been what's hit hard the most in this last week and a half. Again, short time frame, but the Nasdaq 100 down about 1.7%. Same for the Russell 2000, which is small cap U.S. stocks, down about 1.6. Um, some of that might be the outlook for further rate cuts is in question, and we talked about this before, but the lower the interest rate, the lower the cost of borrowing for smaller businesses, which is a good thing for them. So if there's not as much probability on the horizon for a rate cut and lowering the debt service cost for those businesses, that's probably a little bit of a drag. But gold in that time frame, the last week and a half to 10 days or so, up 3.76%. So gold's still having a heck of a year at this point going forward. But it's been a wild ride the last, 45, 50 days since the government was shut down. Um, Government employees were able to get some assistance. So, uh, at least generally speaking, right? Like payroll loans to help get through. So, what we're going to talk about in a minute is probably not a direct cause of the government shutdown, or probably not at all. But where we're at as a country from consumer debt is definitely becoming more of a challenge. Let me share one screen real quick, Kirsten, before we dive into the metrics here. If I can get this pulled up. Want to talk about sentiment going into the holidays, consumer sentiment. Can you see this screen?
Yep.
All right. So the University of Michigan, their survey of consumers, consumer sentiment, you can see for November, the projected preliminary results for November of 25. Index of consumer sentiment overall, a drop of 6.2% from October, almost 30% from November of last year. Current economic conditions down basically 11% since October, 18% since last year. And you can see here this summary, the consumer sentiment fell back about 6% this November overall, uh, led by a 17% drop in current personal finances. 17% drop in current personal finances. It's 11% decline in the year ahead at expected business conditions. So people have a more favorable outlook of the future business conditions relative to their current personal finances, which I think that's a good thing. They both went down, but at least there's some disparity there. So people are a little more inclined. But that 17% drop in current personal finances as far as how people feel. Kirsten, if you want to dive into this consumer debt picture now, I think this is
Yep.
probably a large piece of what's driving that.
All right. All right. Do you see this?
Yep.
Okay. Cool. All right. So, yep, like you said, we're accumulating debt and we're not afraid to have it. So this is just non-housing debt. I want to note that housing debt, this and combined is sitting at about $18 trillion. So housing debt takes up about 13 trillion. And then this is looking at about $5.5 trillion. So you can see where this is all coming from. Some in auto loans, obviously credit cards, some miscellaneous here in the middle, and then another big one really being student loan debt. That seems to be another problem that young individuals are facing, getting into these student loans, not knowing what else to do, and just going fully into them. Another graphic I want to pull up that kind of helps break all this down a little bit. And can you see this new one?
Not yet.
Maybe. Not yet. Okay. I'm afraid it just shared the screen and not. Okay. Maybe now.
There we go.
Okay. Cool. All right. So this one gives us a little bit more of a breakdown as far as days delinquent that we're starting to be on these debts. So these ones are the balances of 90 plus days delinquent. And what we see here is a huge spike. One is there has been in student loans. Right here is where we stand about in 2025. You can't really see here at the end. But another big conversation going on right now, of course, is the auto loans going in delinquencies right now. And kind of breaking up between the borrowers and subprime borrowers, and there kind of be an issue with auto loans. I don't know if we want to kind of get into that, but at least a breakdown of us being delinquent on these loans.
Yeah, do you have that chart for the subprime versus prime auto loans? If not, I can pull it up.
I do not have that one right up.
Okay. I'll pull that up a second here.
Yeah.
So the most recent reports that came out for delinquencies on auto loans, you can see in this chart. Let me make this a little bit bigger. So the red line are subprime auto loans, so loans to households who have less than ideal credit. But obviously, people still need cars, have to have ways to get to work and take their kids where they need to go. Our country is large enough that most of it's spread out. You can't just ride bikes everywhere, and there's not public transportation, especially through most of the Midwest, where that's robust enough to get us where we need to go. But the blue line are prime auto loans, so people with quality credit. You can see going back to 1991, we are now at all-time highs, well, since the early 90s for delinquencies on subprime auto loans. And the opposite is true for the prime auto loans. We're not really seeing much of an uptick there. It's holding pretty darn steady. But what you're really seeing here are kind of the underpinnings of the overall economic situation, I would say, across the country is you have people who have been in a good spot, continue to be in a pretty good spot, and they feel pretty good about the economy as a whole. And then you see households who have maybe had struggles over the last 20 years, uh, quote unquote, working class, blue collar, in the subprime area, maybe the credit's not as good, and it's only gotten worse. And as we know, rent has skyrocketed. The average auto loan payment is astronomical. It's what rent used to be 12 years ago, right? And so, um, again, going back to that University of Michigan consumer sentiment, I think this is a glaring reason why you're seeing people not feeling good about their current personal finance scenarios. And on top of that, we got car insurance going up. So the cost to own a used car and keep it on the road legally with insurance, et cetera, has only skyrocketed as well. So it's not even just buying the car that's a challenge. It's keeping it running and functioning. So um, not sure how this will get in, how we'll improve upon this scenario as a country and the economy. That's especially with younger generation. I think there's an opportunity to help them understand building a career path and earning a living versus just to get a degree and find a job. I think that's going to have to be a huge part of this because this challenge isn't going away. Right? You can think of even going back to the Great Recession. which is this is kind of a wild stat. During the Great Recession, we got up to barely over the 5% delinquency rate, and now we're knocking on the door of 7%. So there are some real challenges at that personal finance level, that we're seeing. Doesn't mean the economy is not going to keep moving forward and progressing, and it doesn't mean that investments can't continue to grow. It just means that there will be challenges moving forward.
I
Nick, go
think
ahead.
that I was just going to say, I think this too highlights the significance of the level of interest rates that the Fed sets and influences, because when we see that the issue with delinquencies is that it's not the same percentage, it's not a higher percentage of delinquencies on the same amount of debt that occurred before. It's increasing levels of debt with increasing levels of delinquency. So it's kind of a compounding issue. And what we see in the overall financial markets is banks that will make heavier restrictions on lending requirements. And also they will have more stringent capital requirements if these are the delinquency rates that they're experiencing. So access to capital is tough. It's tougher to come by loans, just at a general level if delinquency rates are up. And then obviously with interest rates higher, if the Fed keeps rates higher, people are less inclined to borrow money at those higher rates as compared to alternative investments. So it's a little bit of a compounding issue, but like you mentioned, it's really a situation, unfortunately, where the people who are doing well are continuing to do well. And at a household level, it's more the people who have been strained by the budgets, by tighter budgets with higher inflation, higher interest rates over the last few years. Remember, interest rates very heavily determine credit card payments and interest rates. So if you make minimum payments on credit cards and the interest rate's higher, that just means your balance continues to go up and you're not making any progress. In fact, you're losing ground on those balances. And when we see those continue to go up, then that's why there's a very significant importance laid on where the Fed sets interest rates, because it does have a significant impact on many American households that are in the what we would call blue collar socioeconomic class.
What else causes questions and potential strain is the current state of health insurance.
Yeah.
So we should probably recap that. So a big part of the government shutdown, the longest in history, was a disagreement, debate over the subsidies for the Affordable Care Act, which you could say, if it's the Affordable Care Act, why are subsidies needed? It's probably a valid point as far as how the overall program is structured. That being said, to make it quote unquote affordable these last few years, those advanced tax credit subsidies have really been needed and have been very beneficial. So as we stand, the government shutdown is over. That question was not solved as part of that short-term solution. And so as of right now, the Congress has said that they will have a vote at some point in early December as far as whether or not to continue those subsidies for the Affordable Care Act, Obamacare marketplace. But as we talked about last time, open enrollment, it ends on December 15th if you want coverage set for January 1st, right? So you have to enroll by 12/15. And as we stand right now, the cost to say you have insurance, there's bronze, silver, gold levels. The cost to say you have insurance, period, at the bronze level, super challenging, super challenging. And so, Nick, you want to talk about any of the different potential pathways that at least we want to consider when
Yeah.
we're looking at healthcare?
Yeah. And those are things that we've been working with households through right now, because a lot of people, honestly, if their plan was retire before 65 because of something like healthcare.gov, one of the challenges when we are reliant upon, government advanced tax credits, subsidies, is that if they ever go away or if they're ever restricted, then we are very significantly affected by those. And a lot of the plans for pre-65, one option, retiring before 65, has been the ACA marketplace. So alternatives to that would include, there are potential plans through Blue Cross Blue Shield, depending on your age, where you live, might not be tremendously more affordable than the Affordable Care Act plans. Alternatives that we've been helping clients explore include things like if you have a good direct primary care office in your area, that includes basically paying like a monthly subscription, and you can have kind of unlimited primary care access to that particular office. And then carrying alongside of that a catastrophic coverage plan. There are cost sharing ministries and plans available where you choose what you want your initial uninsurable amount to be, which is in a sense similar to a deductible, in that it's the amount of money that you have to pay out of pocket before the cost sharing initiative will kick in and pay for the rest. And you are typically on the hook for 3 of those per year. So it's not identical to a deductible like with a traditional health insurance plan. But those options could save you a tremendous amount of money. And honestly, some of the direct primary care clinics could offer you everything that you need, depending on how often you see a doctor and what kind of medical assistance you need. You could experience even a higher standard of care. So there are definitely other avenues worth exploring. You don't necessarily have to just fall with the healthcare.gov plan without the enhanced subsidies from the COVID period of time. Definitely talk with us or your health agent about what alternatives might exist to the healthcare.gov plans that you might have been using the past few years.
Yeah, because what I just walked through while he was explaining that was if we have a husband and wife in Lee Summit, Missouri, Kansas City, Missouri area, they're both 60 years old. On paper, their gross income is going to be 110,000, and for the purposes of the Affordable Care Act, healthcare.gov, on that income number, you have to include dividends and capital gains and taxable interest. It's not just your pension or distributions or other income sources or self-employment income. It's everything that shows up as taxable income on your return. So that's why I plugged in 110,000. That doesn't mean they have it doesn't mean they have almost 10 grand a month in income. It just simply means that's what's going to show up on paper. Now, in that context for next year, the cheapest bronze plan available at this point would be $1,878.36 a month, just to say you have insurance. In addition to that, the deductible will be 15,000 and out-of-pocket maximum 20,000. So again, I wouldn't call this the Affordable Care Act, but that's a discussion debate for a different day. And so, again, we're not right. We're just talking about different options that we consider when we help households walk through this. There's not one answer for everybody, and we're not recommending anything. We're just simply laying out here are the options. Sometimes, if there's a short window to bridge and someone retires, sometimes at this point, especially continuing coverage using Cobra, if that's an option, some employers, it is available. Sometimes paying Cobra, which we used to think about as that's just the most expensive option ever. There are instances right now where that's actually better coverage and cheaper than what we're seeing on the Affordable Care Act options at this point. Again, there's supposed to be a vote before the December 15th deadline for open enrollment for January 1st. I'm not holding my breath. So we really need to work through what options we have to really have coverage. Direct primary care, and you can simply Google that, and there pretty good explanations of what that is, right? How that works, where you're paying a monthly membership fee subscription essentially to have often even 24/7 access to healthcare team that's local. But I'll give you an example here in Columbia, Missouri. There's a few different options where there are direct primary care clinics that are actually a team of multiple doctors and RNs, registered nurses. And on average, you're looking at for an adult, $80 to $100 a month to have 24/7 access. And then Nick mentioned there's different cost sharing organizations, nonprofits, ministries, or catastrophic coverage. And one example would be there's a organization that's been around a long time called Sedera. Again, this is just one of many, but these are paired with direct primary care options, and it even refers to that here as far as the DPC. And when you look at um, membership costs, again, this is not insurance. You can't use insurance terminology, but you can at least come and explore options and say, okay, if I have direct primary care through a local doctor team, well, it's a little bit lower cost. So you can see if we were looking at that same couple in Lee Summit as an example, and they're 60, it's a member and spouse, okay? Member and spouse in the 60-year-old range. If they want their initial unshareable amount to be the lowest possible of 500, then it's $1,242. And you could say, okay, if they're both paying for a direct primary care membership, that's another 200. So that's still less than $1,500 a month. Again, this is not insurance, so there's differences. But if that makes sense, there's a lot of other things to consider, especially pre-existing conditions is a big one. But if it makes sense, that's cheaper than the cheapest bronze plan available, and you can, and a lot of these cost sharing organizations and ministries function the same. So you can play around with some of these numbers and say, okay, hey, if I'm comfortable with initial unshareable amount of 2,500 per incident, I could get that number down to basically $900 a month. And so there are at least options, and there's not one size fits all answer, but the reality is at this point, we're having this conversation a lot as of late, just because we're coming up towards a new year and we have to have these things figured out for our own households and healthcare. So just wanted to lay that out in a little more detail. If you have questions, want to talk through this with us in detail, please do reach out. If you have friends, family, people important to you who are struggling through this and are trying to find different pathways, have them reach out to us as well. We'd be happy to chat through that with them. So, aside from that, there's a handful of normal changes that happen every year. Nick, you want to give us a breakdown of some of these inflation adjusted numbers that will impact our day-to-day life?
Yeah, so some of the, I guess, semi-positive impacts of inflation would be that the IRS will typically reevaluate and even increase the limits with which you can contribute to a 401k or an IRA. We've actually seen contribution limits on 401k, so your workplace plan or 457s or TSP contributions increase all the way to 24,500. So that's up about $1,000 from last year. And then IRA contribution limits have increased from 7,000 to 7,500. These do not include catch-up contributions. So if you're over 50, you can contribute more. If you're over 60 to 63 in a workplace plan, you can actually add over 11,000 to these contribution limits to your 401k plans. So with higher costs, higher prices, increased government debt, questions about subsidies for insurance plans, etc., comes increases to the amount that you can save for retirement. I will say this, oftentimes it makes sense to at least have a discussion with a financial professional about what makes the most sense as far as how you save for retirement. And I don't just mean what account you contribute to, but also what type of an account, whether it's traditional Roth, pre-tax versus already tax or post-tax. But generally speaking, your workplace plan is where you're going to be able to have the greatest impact on accumulating your retirement growth. And then even after 59 and a half, you can continue to contribute to that account, but maybe gain better access to actively managing those funds with better risk managed growth potential. A lot of times you're able to transition those under your own management or to the management of an advisor after 59 and a half. So you can make good progress contributing to workplace accounts, especially up to that 59 and a half and beyond. But if you're self-employed, evaluating options like SEP IRAs or simple IRAs and contributing to those types of accounts could make the most sense for you there. Another inflation adjustment, which we talk about this a lot, how the Social Security cost of living adjustments usually move in step with increases to Medicare Part B premiums, which we recently just got the release for next year. And just for the base level of Medicare Part B premiums, which was 185 this year, they're going up to just under 203 next year, 202.90. So almost an $18 increase. So if you had a 2.8 increase on your $2,000 Social Security amount, that's $56 a month. And now, A, depending on your income situation, that's probably getting taxed at some level. B, you're giving $18 of that away to higher Medicare Part B premiums if that's your insurance coverage of choice. So yeah, inflation affects both sides of the spectrum, but unfortunately, higher Medicare Part B premiums adds kind of a little bit of fuel to the fire of talking about how to make insurance and health care more affordable for everybody, including seniors.
Yeah, on the tax side too, I'll share this briefly, but that those inflation adjustments affect tax brackets as well.
Mhm.
So a lot of households find themselves in the 12% tax bracket, married, filing jointly. I shouldn't say all, but a good number of households, right? And this number is taxable income. So for 2026, the upper end of the 12% tax bracket for married, filing jointly is going to be 100,800. So that's an increase of over $4,000 from 2025. And if you have, let's say, a couple that's they're both at least age 65, for at least for the next 3 years, they're going to get an additional standard deduction of 6,000 each. So that's a $12,000 standard deduction for a married couple where they're both over 65. The tax bracket just got moved up by another 4,000. So this is an example. This doesn't apply to everybody, but like this is something where these adjustments could, for some households, allow them to do $16,000 more of a Roth conversion next year than they could have this previous year, just because of some of these adjustments that we don't dictate or change at all. The government does based on inflation. So there could be some really positive planning opportunities that we'll look at going into next year. But it's important to stay on top of all these different numbers and changes so that you're really maximizing the overall picture, both like Nick said on the retirement savings side, but also minimizing taxes along the way, whether you're in your 20s, 30s, 40s working or at that work optional stage of life and 60 plus. So um, again, there's a lot of positive things happening, a lot of opportunities. Don't want to talk about doom and gloom stuff all the time. It's just we do have to understand the reality of things that are happening across the board and to our neighbors, et cetera, as far as the interest rate and lending situation and personal finance outlook, especially as we're going into the holidays. People usually get more on edge anyway. And if we saw a 17% decrease in their sentiment towards their financial situation, maybe we can just all be a little more gracious and patient with each other over the next couple of months. So, Kirsten, did you have a calendar for us to look at that we might actually have
I
data or
I
data
sure
coming in?
do. Yep. Oops. All right. We here.
Did you guys see that we might not get some of those reports ever?
Yep.
Yeah, so I
So
was just gonna say I saw that it looks like some of those October reports might just be void and gone, and they're not even gonna backfill or find reports for, which is
yeah, so if you're listening at home and we're pulling up a chart going forward and there's this gap in data for October of 2025, that's not our fault. That's the government's fault.
yeah. Well, and I already saw them starting to kind of say, well, even some of the reports coming out later this week that they're already saying maybe not going to happen and that they're all still in the process of accumulating data and reports over that happened over the past month. So anyway, needless to say, we land here at the 17th. Yeah, we did not get that CPI report from last week, of course. But moving ahead, hopefully we start getting these reports. So coming up, we have
Does
FOMC
that mean
minutes.
there was no inflation?
Right, yeah, for sure. I think so.
Costs did not go up. There we go. Let's celebrate.
We've got no graph to point to that says it did.
Fair enough.
Um, let's see. So that leaves maybe Wednesday with some housing starts and permits if they're able to compile all that data in time to let that report come out, as well as existing home sales. We've continued to track the what homes are being built and especially how we're not seeing enough single family or starter homes being built. So let's see what those housing start and permits are and the home sales for this coming week end up being. Leading economic indicators, weekly jobless claims. Again, I don't know how quickly they're going to compile all the data as far as job reports. I know we've been relying on the private sector reports lately, and it'll be nice to get some real numbers coming back. Followed up with consumer sentiment coming out this Friday. Tyler touched on one of those kind of similar reports as far as how the consumer is feeling on the personal financial level. And into next week, we have some more pending home sales, consumer confidence coming in. And then at the end of the month, we have GDP coming in, which will be interesting. I remember we looked at a graphic, I believe, last time we spoke as far as the government shutdown and the effect that it has on GDP. So be interesting to see how that all starts to shake out in these reports coming up.
Yeah, one thing that's really interesting, just in the context of the existing home sales, and even thinking back to the October 29th was the last Fed announcement that they were cutting rates for the second time, in the last few months. What's been kind of interesting is, so mortgage-backed securities, their price levels and how they fluctuate is what actually directly impacts mortgage rates, not the Fed changing rates. That actually doesn't have any direct impact on mortgage rates, although that's a common misconception. But what's interesting is mortgage-backed securities are generally seen as a flight to quality, kind of like a bond, with the higher lending restrictions and regulations in the mortgage industry coming out of 2008 and the big housing crisis that we had then. There's a very strict underwriting pattern with mortgages. You have to be really well qualified to obtain a mortgage loan. So when these are bundled and sold as mortgage-backed securities, that's generally considered to be a pretty safe investment. Well, the Fed lowered rates, which typically you would assume that there is a little bit of there can be a flight to quality around that time. Well, on October 28th, the average 30-year fixed mortgage rate, according to Mortgage News Daily, was 6.13%. Today, it's about 6.38, which is almost exactly 0.25% higher. So the Fed lowered rates and mortgage rates have now gone up 0.25%. So in the grand scheme of things, the overall market as a whole, I think probably what we've seen the most significant impact from is the fact that the Magnificent Seven, the 7 largest market cap companies that make up about 37% of the overall market capitalization of the S&P 500, is if you're really heavily concentrated in large cap companies, then you're largely going to do what those 7 companies do. And when a lot of them are tech focused, or there's a big emphasis on tech in them, and we've seen a little bit of a tech pullback lately, it looks like the market is doing poorly, right? Well, the sentiment, based on everything that I just spewed out about the mortgage-backed securities and the flight to quality, is that people aren't moving to safer investments like mortgage-backed securities and bonds quite as much as people think. You would think with a pullback in the market that might be the case. People are actually not flooding the bond market and the mortgage-backed securities market, which is why mortgage rates have actually gone up. So kind of an interesting dynamic. The Fed lowers rates, mortgage rates go up 0.25%. It seems like investors are still pretty resilient to take on risk in the market at some level.
And ultimately, that's a net swing of 50 basis points to a certain degree, right? Fed cut it by a 0.25 point, and then mortgage rates go up. So, for those who got excited to pull the trigger on a new home loan, that was probably a little bit discouraging at that point. So,
yeah.
Well, our next time that we'll get to join you is after Thanksgiving. So we really wish you all a blessed and fun and enjoyable Thanksgiving with those you care about most. If there's anything we can do for you in the meantime, before or after, please feel free to reach out. You can get a hold of us at 573-302-7212 or through our website at srgfinancialadvisors.com. We appreciate your time and we'll talk to you soon. Thank you.